Over the past few months, investors pulled a strategic amount of money out of digital asset funds. In June alone, U.S. spot Bitcoin ETFs saw roughly $4.5 billion walk out the door, the worst single month since these products launched. And here's the kicker. One fund, BlackRock's, accounted for something like 3/4 of that. When the bigger player heads for the exit, the whole market feels the floor move. Now, the price told the same story. Bitcoin, which has been trading like the shiny new digital gold, suddenly wasn't shiny at all. It broke $60,000, a level that had held like a fortress for all year, and slid to around 58,200. That's 21-month low, and the fear gauge that tracks crypto sentiment fell to 11 out of 100. 11. That's not just fear. That's I never want to hear the word crypto again zone. Now, one thing you need to understand about the fear gauge is the lower the worst. And I'll talk about this after. But now, here's a part the headlines mostly missed. Right at the start of July, the selling stopped. A 10-day streak of outflow, more than $2.5 billion leaving, snapped. And over 3 sessions, about $510 million came back in. BlackRock funds had a single day of $209 million in inflows. And as of today, the 14th of July, Bitcoin has climbed back to roughly $62,600. If you're one of my members, you know exactly what I'm talking about. I talked about this before, and I talk about it every morning now. So the story, in one sentence, the most brutal outflow wave in this market, short history, has showed its first real crack. And the crack is the green bar on our chart. Do you see it? Right there. Now, why do these bar charts matter more than the price itself? Well, because flows are the fuel. Price is just the speedometer. When money is pouring into these funds, someone has to go out and buy the actual Bitcoin to back the shares. That's the real buying pressure, week after week. When money leaves, that engine runs in reverse, and the selling is mechanical. It doesn't care about your feelings or the fundamentals. So when you look at this chart, don't just look at how big the bars are. Look at the rhythm. See that cluster of tall green bars back in late 2024? That was euphoria. The record inflow. These are red patches in early 2025. And again this summer, these were the panics. And notice how the deepest red bar, the biggest single week outflows, tend to cluster right near the price lows and then get followed by a flip. That pattern, the deceleration and then the flip, is what seasoned analysts watch for. It often marks the movement. Sentiment turns before the price does. What's going on? This money is going back into Bitcoin. That's what's happening. At least it started to. Keep in mind that Bitcoin hasn't done well. Why? Well, because they were concerned about the fact that rates were going to go up. A new guy came in, the new Fed chair came in, and they said, "Oh my God, he's going to raise rates." And in a couple of weeks ago, I don't know if you remember, they were showing about 172,000 new jobs. Instead of the 80,000, the market dropped by 4%. They say, well, this is it. Inflation is back. It needs to raise interest rates. And higher rates is the worst thing that could happen to crypto. But now with Bitcoin, what's happening is that, inflation might be actually under control after all. Market is inching itself very slowly back into the game. But be careful. You want to be the first one. You want to be buying when everybody else is selling, and selling when everybody else is buying. You want to be the first, not the last. So let's take a look at this chart. Let's zoom out, because we've seen this before. And history is oddly encouraging here. Think back to late 2024. Crypto funds saw some of the largest weekly inflows ever recorded. Week after week, all tall green bars, total assets smashed records. Everyone was a genius. Then back early in 2025, and a wave of tariff worries hit every risk asset on the planet. Flows went red under asset management, and yet the market found its footing and climbed to fresh or new highs later that year, above $126,000. Here's a lesson, and here's a big one. Every single one of these washouts felt like the end at the time. Every one. The outflow, the scary headlines, the crypto is dead takes, they showed up at the lows, not at the high. That's the nature of the markets. The maximum pain and the maximum opportunity live at the same address. Look at this price line. That's about 54% drawdown from top to bottom. Sound catastrophic, right? But here's the honest historical context. Bitcoin has done this many times. Drops of 50, 60, even 70% are not the exception in this asset. They are practically a rite of passage. And every prior time, the recovery began exactly like this one appears to be beginning quietly, with the flows turning first, while most people still look away. Now, I'm not here to tell you that past guarantees the future, but it doesn't. But when the setup rhymes this closely with past turning points, a thoughtful investor at least sets up straight. So what is the economic background, right? What's going on? So why did all this money leave in the first place? That is a question we want to know. This was really about Bitcoin technology breaking? Not really. It was about the weather, the big picture money conditions. Three things drained the tank. The first one, the Federal Reserve had been holding interest rates high, which makes safe stuff like cash and short-term bonds pay out nicely. So why take a wild ride? Second, the dollar was strong, and a strong dollar quietly presses down on everything priced in dollars, crypto included. And third, a lot of adventurous money rotated out of Bitcoin and into red-hot AI stocks. It wasn't a crypto funeral, it was a capital chasing a shinier trade. Now read this one simply. The tall red bar in June, that's $4.5 billion exodus, right? And the little gold bar for July, right? In the early July, tentative turn back towards inflows. 1 month doesn't make a trend, but the direction of the US bar is what matters. And here's why the backdrop is quietly improving. The Fed new chair, Kevin Walsh, has started leaning more dovish. That's the market's word for friendlier, meaning more open to eventually lowering rates. Treasury yields have softened and the dollar has eased off a bit. Not a lot, a bit, which loosened the pressure on risk assets. On top of that, there's a crypto market structure bill, the Clarity Act, with the hearing coming up on the 17th of July. Clearer rules tend to invite the big, cautious institutional money that's been waiting on the sidelines. All of it add up. And the same forces that push money out are starting gently to reverse. So if you're getting value out of this video, don't forget to subscribe. It is helping you, see the board more clearly. Do me one favor, smash the like button and subscribe. Now, let's put on the lens this channel is built around. Most people hear black swan and think disaster, crash, doom. And sure, that's one flavor, but here's a piece almost everybody misses. Black swans point up too. A positive black swan is a rare, oversized surprise that pays off far more than anyone expected. And the people who get paid are the ones who were positioned before the surprise. Taleb's real obsession isn't predicting swans, it's about asymmetry. Setting yourself up so that if you're wrong, you lose a little, and if you're right, you win big. And I want you to look at where we are right now through exactly that frame of mind. Read this chart. Take a look at it very carefully. The higher the line, the greedier the crowd. The lower, the more terrified. That green band at the bottom is an extreme fear zone. And we just visited the basement not too long ago, a reading of 11. Now, think about the asymmetry that creates. When everyone who was going to panic, sell has already sold, who's left to sell? Right? This is the fear and greed index. If you knew one of my members, you know exactly what I'm talking about because I talked about this quite a bit in the past. That's the positive black swan setup in a nutshell. The downside has already happened. The record outflows, the 54% drop, the extreme fear. What's not priced in is a possibility that money floods back faster than anyone expects on the back of friendlier Fed policy and clear rules. You don't need to bet the farm to benefit from that. You just need to be positioned sensibly before the crowd believes it. That's the whole game. So let's bring this home. One green little bar that you can't even see. After the worst outflow wave this young market has ever seen, the money just started, tentatively to come back, while fear is at rock bottom and the big picture weather is quietly clearing. It might be a false dawn, or it might be the first fragile hour of the next chapter. Our job was never to be certain. It was to see the setup clearly, weigh the whole range of outcome honestly, and position with respect for both the upside and the tail. That is the black swan way.